Good news is I'm not going to have to because we are live on Facebook for the Tuesday edition of the Not Your Average Investor Show. Welcome, everybody. Good to have you all here. We've got some of our favorites on board that have already been making fun of me in the chat today, which is nice. Lee Bishop especially. Shout out.
Thoroughly encourage that, everybody. The more you can make fun of us together, the better we're all going to be. That would be fantastic.
It's true. You know, I look back at my life, and I don't know if it's because of my family structure or what, but most of my best relationships are based on mutual making fun of each other. So highly encourage it. It's a key to my heart and cooking. So with that being said, this is our Tuesday edition of our show. It is usually a interview format or it is instructional. We'll be teaching you something, and then we move on to Q&A as the show goes on, but we want everybody to participate, right? We want you to be part of the show. And in order to do that, there's two ways. One is to click that little chat button on the bottom left. And if you want everybody else to see what you're writing, you got to hit that little blue box that says all panelists and change it to all panelists and attendees, or else only Greg and I see what you're typing. And second is, if you want to ask a question on the show, you want me to ask Greg from his infinite wisdom, put it here in the Q&A. You hit the Q&A box on the bottom right and pop it in there. That's the easiest way for me to keep track of it. And really, you're just doing me a favor. If you put it in the chat, I'll probably get it also, but you might see me short circuit and chew my lip for a little while, as Lee has clearly pointed out that is my habit. And last but not least, if this is your first time coming and what you are looking for is a real explanation of the whole business model, rental income property investing, how to do it, what markets are the best, what to look for in properties, why JWB is better than everybody else, go to jwbwebclass.com, and that you'll spend a quality 45 minutes with Greg, giving you everything that you need to know to really, really understand it at a basic level. And then second is, if you are ready to move on, right? If you have a question that needs some specifics, you want to apply it to your portfolio, what your next move is going to be, go to chatwithjwb.com, pick out the best time and date for you to hop on a call with one of the mics, and you move forward that way. And Greg, by the way, I booked my call.
You did?
I have it. Yeah, Stets. I got a call with Stets coming up early August.
I saw that coming through. I was like, I didn't know if that was real or not, if you were just testing or whatever. That's awesome, man. Congratulations.
It's real, man. I've been going through my my old IRA, my 401k. I've been looking at my bank accounts. I'm like, all right, man. You know what? It's time to stop faking the funk on this show. But
that's awesome, man.
Yeah.
Very, very happy for you, man. That's fantastic. So,
yeah.
Are you scared about jumping on the phone with the mics?
No. I can't say that. I can't say that.
What if they're super salesy and just trying to sell you, dude?
You know, the conversations I've had with the mic so far do not make me think that that's going to be the experience, right? So I'm pretty excited about it. Honestly, I'm really excited just to be like, hey man, this is what I got. I'm about to buy a house. Like, what do you think? And go from there, right? So and then on top of that, be able to relay the experience here on the show for everybody. So I think it'll be cool, man. But without further ado, this isn't the Pablo trying to figure out what he's going to do with his life show. This is the Not Your Average Investor Show. So to serve that, Greg, I didn't even intro us, man. I'm your host, Pablo Gonzalez, my co-host, Gregg Cohen, who's the co-founder of JWB. And Greg, yesterday, I know that we hosted, and I got the honor to moderate the client-only call. That is the state of the rental income property market in Jacksonville as of, the first half of this year and everything learned. And we're going to share some lessons from that call, man. So I'm going to let you kind of set that up right now.
Yeah. Wasn't it just a cool experience to be there with our clients? We were there. My business partner, Alex, was there as well. And just the simple fact that, when we started this company, there was nobody that was going to trust some like 20 somethings, with their money. And nobody was looking at us as real estate experts because we weren't real estate experts at that point. And, just the simple fact to be able to jump on a call like we're able to do, and to have 75, 100 of our clients join the call, and all investors here in Jacksonville, all building that long-term passive wealth, and all really excited, not just about what we have to share, but about the investment, about the property management. It's like we've taken this asset, which is, notably boring to talk about for most people, and we've taken away from the transactional part of it and taken it into this conversation of what it can do for you and for your wealth and for your retirement or for whatever goal you may have. And coming from, nothing and 0 followers and 0 fans and 0 clients to having 75 to 100, what a special experience. And I'm glad that they were able to get to know you and get to know the show a little bit more. We're constantly trying to make sure that our social presence and our clients are linked. And so it's great to have a lot of our clients that are on these calls. And we appreciate all of you for making your time out of your schedule to be here. And what we're going to do is we're going to bring a lot of the content that we share just for our clients here on the show. And that's what we're going to try to do today. So every quarter, Alex in our office, our president, Alex, really heads up our Jacksonville Real Estate Market update. We share it with our team, and we thought, why not take this opportunity to bring you all in the loop as well? So I think that's where we'll start. Okay.
Love it. Love it, man. Well, go for it.
And with that, without
that
further
super
ado,
smooth transition.
Without further ado, let's jump into it. So, all right. So kind of bring everybody up to speed. We should start with sort of when the world changed during coronavirus, fully understanding the brunt of coronavirus in mid-March. And a lot of people were asking about what the real estate market is going to do. And Pablo, I'm sure you can remember a lot of those times we went on the air and we said, listen, we don't expect a drop in prices. We understand that there's going to be unemployment, but we don't see prices dropping. And what was the reaction to a lot of people when we said that?
There was you were met with some funny looks, right? Like, and I know that you were walking into it meekly, like, hey man, this is just what I believe, and I'm just like, Greg, I think if this is what you said, you're gonna get a chance to be right or be wrong, right? So throw it out there, right?
We were, and we just looked at the data because in our history of investing in rental properties, the data wins, and it won in 2006 when we bought 40 rental properties at the height of the market. And then we weathered the storm of prices dropping over 35% in the subsequent years. And we weathered the storm. We saw that values do actually follow a pattern of coming up to historical appreciation rates. And of course, the cash flows are really strong all the way throughout. So I still own those properties. We weathered that storm. And we went back and we looked at what could we have learned from that experience that could have given us a leading indicator of what prices would do. And what that leading indicator is called months of inventory. So when we talked about what was going to happen with COVID, that's the first place we looked. We wanted to see months of inventory. We wanted to see how many houses are on the market and how many sold last month in Jacksonville. And like anything else, pricing is determined by supply and demand. If you have a whole lot of inventory and things are not selling, you would see downward pressure on prices. And if you have very small amounts of inventory and things are selling really, really fast, then you're going to have upward pressure on pricing. Regardless of COVID, regardless of anything else, if you're seeing these things, this is what the leading indicator of pricing would be. So to kind of get everybody into perspective here, an equilibrium market is known to be between 6 to 7 months of inventory. And an equilibrium market is where you would anticipate normal home price appreciation. Pablo, what's normal home price appreciation in Jacksonville?
4.3%.
Nailed it. Historically, since 1991, if you looked at the average appreciation rates year over year in Jacksonville, you would find that we've appreciated an average rate of 4.3%, which is higher than the national average and 34% more than comparable cash flow markets. That's why we're a growth market. All right, so that's 6 to 7 months of inventory. Now, we've been tracking months of inventory all the way back to 2014. For the last few years, since 2016, we haven't even gotten to 4 months of inventory. We've been in the 2 and 3 months of inventory, which signifies that we should have higher than normal home price appreciation, higher than 4.3% home price appreciation. Pablo, do you think we've had higher or lower home price appreciation since 2014 and 2016? Higher, right? Months of inventory has indicated that, and that's what's happened. All right. Now, it isn't always that way, right? When you go way above 7 months of inventory, like we had in the crash in 2007 and 2008, we had upwards of 11, 14, even 18 months of inventory. And so it's easy to see what was going to happen in the next 6 to 12 months when you have that. But that is completely different than where we were walking into COVID. So we looked at the data and we said, all right, where are we? We were at like 2.5 to 3 months of inventory walking into COVID. And we said, here's what we see happening. Now, we don't know all the variables, but what we can expect is that home sales would probably dip. Home sales would dip. The number of homes selling, because social distancing, people aren't leaving their houses. We didn't know what the effect was going to be on unemployment. We didn't know what interest rates were going to do, whole lot of variables. But we said it's probably realistic that you would expect home sales, the number of home sales, to dip. And then we looked at it and we said, how much would home sales have to dip for us to get above 7 months of inventory? And it was a lot. It was a huge amount of a dip. It was 50% of sales is what we would need in order just to get to what is really an equilibrium market, which is average appreciation. So just sharing with everybody, that was our mindset going into COVID. And that's why we came strong. And we said, we don't anticipate a decline in home prices due to COVID because we have such a long runway. We don't expect sales to dip 50%. And even if they do, that still wouldn't indicate lowering of home prices for us. So that was our basic thesis. And it's really cool to be, sitting with you all here at the end of July and be able to share some of these numbers with you, because guess what? We were right. We were right so far, right? Now, this doesn't mean this is the end all be all to this kind of thesis, but at least what it does is it shows you and brings some credence to how you can make these decisions for yourself. There are metrics, there are leading indicators, and you can rely on those to form your opinion of what the market is going to do. Pretty cool, huh?
Yeah, really cool, man. I think that's a really good framing of the explanation of why you were willing to go out on a limb and put it on the internet where it will live forever, right? But I think everybody wants to know the actual numbers, right?
Let's do that.
Why don't we get to
okay.
it? Yeah.
So let's bring up the months of inventory slide first. Okay, there we go.
Ahead of you, bro. I'm way ahead of you.
So good. We're just locked in here. So, all right. So when we're talking about months of inventory, again, 6 to 7 months is an equilibrium market. That's what you can see in the top, in the slide there at the top. And the lower number, and you're going to have to help me with the colors probably. I'm colorblind. What's the color on the lower
It's a blue
line?
It's a blue.
Blue. All right. The blue line, right? That is what our actual months of inventory have been over the last few years. So well under 6 months of inventory. And you can see we're at an all-time low right there, right? In the month of June, based on current data, we're at 2.39 months of inventory. What we're seeing overall is that the number of listings, number of houses on the market is down slightly from previous months, and the number of sales is actually much higher. We'll get into that right now, actually. Way to go. We are just so in line here. So what you're seeing here are the number of sales from March to June. So when COVID broke, we thought that there was probably going to be a decline, which is what you saw in March and April and May, right? We had a little bit over 2,300 sales in May. In March, it was 2,700. And when I ran some of these numbers, we were down maybe about 20% or so year over year in terms of home sales, not home prices. But interest rates and the acceleration of people moving to Jacksonville has had a huge effect. And you can see in June, we had 3,100 sales. That is the highest number of sales in any month in Jacksonville's history.
Insane.
That's a lot.
That's
a lot, right? We're looking at the numbers for July. July is trending the same way, maybe even more. So, obviously interest rates are driving this. We talked a lot about this on the call. I'm sure we'll spend some time talking about interest rates, but when you're able to acquire long-term debt at such low interest rates, what that's doing for you, and as far as rental properties, is increasing your cash flow. It is allowing you to take advantage of this tool, this debt, which is only going to get more valuable for you the longer you hold it due to inflation. And it's devaluing the debt, meaning that it's easier for you to pay it back. And people are looking at this, and it's at the same time, obviously people are somewhat getting back to work, and some of the fear and paranoia of what COVID meant has dissipated a little bit. And what you're seeing is a lot of people that are buying houses in Jacksonville right now.
So what's that doing to pricing?
So that is increasing pricing, right? Again, lower the months of inventory, the higher the pressure on pricing. There's not enough inventory to support the demand right now, so prices are going up. So let's bring the slide up for the actual numbers here. I think I know them by heart. $255,000 was our median home sales price in Jacksonville at the end of June. There we go. Nailed it, right? That's where we were, $255,000. That's up from about $246,000, which is where we were at the end of May. So a sharp increase there. I don't pay too much attention month over month increases though. You really want to look year over year, and you really want to kind of smooth it out with like the last 6 months of data, just so you don't get too excited or too depressed on what the values are doing there. But our year over year home price appreciation rate in Jacksonville has been a little bit over 4.5%. You can compare that to our historical average of 4.3%, which is what we've been at since 1991.
Greg, let me ask you something. This is home price appreciation. In your analyses that you create for your buyers, you don't reference home price appreciation, right? Like you are selling a cash and tax depreciation, tax savings, principal pay down, return, and this appreciation is just kind of like the multiplier that makes it sense to hold long term, right?
Absolutely. I think of appreciation as an extra bonus on top. You make the decision because you can invest and get positive cash flow with a world-class team to manage it for you. And if you invest in a growth market and you hold on for a full market cycle, which is between 10 to 20 years, that's the only time you can count on home price appreciation. So while we could go into our valuations and sing it from the rooftops that these assets are going to return over 20% for you based on conventional financing, based on expected appreciation of 3-4%, we don't. We want to be conservative. We want to attract clients that love the passive income nature of this first and foremost, because that's what I can control for the most part. I can control renting the house for you. I know what the rent rates are. I can't necessarily control what your exit timeline is. And if you're not in for 10 to 20 years, I don't think you can count on home price appreciation, right? It's when you give it time for a full market cycle to work. So yeah, so we don't. So our estimated returns on investment, for those who are interested, you can go and check it out on our website at jwbrealestatecapital.com, and you can just view properties there. You'll see our estimated returns do not include expected appreciation, and those expected returns are between 7 to 9% for the assets.
Got it. So me, as somebody who has a call coming up in a couple of weeks to figure out how I'm going to allocate money into this asset class, when I'm thinking about these numbers, this is just helping me decide, okay, maybe it's not time to sit on the sideline, right? Like, if I'm thinking, am I going to get a deal in a couple of months? These numbers are telling me there's no deal to be had. Just go with like the fundamentals of whatever's going to happen, right?
Yeah. When we're helping clients buy houses, it's not that approach that's like, hey, this is the deal. You got to buy this deal. This is the best deal ever. Our approach is, listen, this is the model that we subscribe to. And we have been doing this for 15 years. We put our own money in these neighborhoods. We know everything about these neighborhoods. Let's buy into a 7 to 9% return that is passive to you. That is like set it and forget it, right? You've got a team handling everything for you, allow you to get into this asset class. And then let's have you hold on to this thing for 10 to 20 years and be pleasantly surprised with the home price appreciation that comes as a part of it. So the deal that I was sharing with our clients yesterday is I always love our houses. I'm going to say the same things about our houses I did 10 years ago as I will for the next 10 years. It's positive cash flow, right? 7 to 9% returns, right? The deal right now is the interest rate. Because when you can lock up an interest rate in the 4% range on money that you have in place for 30 years, and it is responsible debt, right? It's not over leverage. It's on an asset that pays you every single month, including your mortgage payments. That is the deal. Never seen interest rates this low. It's never happened. Freddie Mac releases interest rates every single month. I went and looked it up online since 1971 when they started reporting. It has never been as low as it is in July of 2020. So when we're talking about the deals, more often than not, for those who are current clients, I'm sure you can share your experience here, or those who are thinking about clients, you talk to JWB, we're going to ask if you want to buy into this model overall. Don't get so excited about this individual property or tell me that this other property doesn't work, right? If you buy into the model, they're going to work. All the properties are going to work. But this really is a special time as far as interest rates. That is really the deal part of it.
That makes a lot of sense. So do we want to move into, let's talk about interest rates, right? Because we just had was it 2 weeks ago? We had Rich Ritchie on here. He was kind of the guy that put it on my radar. Obviously, he's a good friend of mine, came on the show, and he's a VP of mortgage banking. And he's the guy that's like historical opportunity, right? Like if you can look back to 2002 and buy houses, or 2010 and buy houses, and wish you would have done it in reverse, more power to you. But right now we are in this window for this specific asset class where there is a spread between financing and just locked in cash flow and appreciation that is creating an opportunity where you can see it transpiring in real time. And I was hoping maybe you can just go a little bit more into that detail, because you got excited about the deal there, but in case anybody wasn't there for that call,
Yeah.
can you go into that?
It's, how many of us are Monday morning quarterbacks when it comes to making investment decisions, right? How many of us on the show have said, oh man, real estate values 5 years ago were a lot less than what they are right now. I should have bought my rental properties then, or I should have bought more rental properties then, right? We all do it, right? Interest rates dropping like they have right now allow you to do something and have a do-over if you're a Monday morning quarterback. Really. I mean, your cash flows are a function of how much rent you can collect and also how low your expenses can be. So when you drop interest rates a full point, which is sort of where they've dropped since a year ago, you've increased your cash flow tremendously. I actually ran the numbers on it. And just by dropping your cash flow on a typical JWB property and loan that you would get, you're going to save $75 to $100 a month in interest into your total mortgage payment, right? And that $75 to $100 a month goes straight to your bottom line. That's a huge boon to your cash flow and to your return on investment for all things not named home price appreciation, right? Saying it a different way, and I don't have the exact numbers on this, but you could have bought a property a year ago or 2 years ago or 5 years ago for a lower price, had an interest rate at 5.5% versus maybe 4.5% right now, and gotten the same cash flow and gotten the same return on your investment, right? So it is really like an opportunity to go back in time, get a deal, right? Buy something in a sense under market value, because at the end of the day, if you're looking at through the lens of cash flow and return on investment, these low interest rates are creating that opportunity for you to go back in time, in a sense.
That makes a lot of sense. So where do you think interest rates are going for the time being? Do you think they're going to rise quickly? Do you think they're there for the next year or so?
I don't think that they're going anywhere. I think they're going to stay low for a period of time. I've read a few things. I think for the rest of this year is pretty widely accepted that the interest rates are going to stay low. I mean, what happens is, as interest rates can't stay low for forever. It's not good for the country to do that. And basically what the Fed typically does is, as the economic drivers get better, as unemployment goes down and GDP goes up and all of these things, they will make interest rates higher and higher and higher again. But the focus right now for everybody named government, Fed, everybody, is how do we get this economy back on its feet? Obviously we have an economy right now which is supported by the stimulus. And, that's why you're seeing a lot of things not as bad as they really are, right? If we remove the stimulus, our economy would be in a much worse spot. We need to make sure that the real economy gets healthy again. It's going to be a while before that happens, right? Many people are saying it's not as bad as it is right now. It's probably not going to go back to 100% before COVID for a very long time. We might be 80 or 90% of the economy. And that last, call it 10, 15, maybe 20%, it's going to be really hard for us to get back to. So that's sort of where you start to see them maybe loosen up on interest rates and actually have them not so artificially low. But I don't see that happening for the next year. So this is a great opportunity for you as an investor, because not only can you buy a property right now, maybe you've got money in the stock market that you're not happy with, you can transition, and maybe that's enough for one down payment, right? A typical down payment at a minimum is $40,000. Maybe that's enough. But you can also start to plan maybe once a quarter, maybe once every 6 months, and you can start to really take a chunk out of your passive income goal, right? How many properties you need to get into your portfolio so that you can retire early, or, donate to charity, or whatever it is for you. You might be able to really take advantage over the next year and put 2, 3, maybe 4 properties into that plan. And again, lock up interest rates in the 4%, which I've never seen in my 15 years of investing. And I don't think I'll see it again for a long time, once we get out of the COVID mess.
Sure. Makes a lot of sense. And we're getting great comments here. So Lee Bishop puts cash flow is king, Pablo. Maryland puts lower interest rates in history are king, Pablo. and
We love the
Roland
king.
puts,
Long
yeah,
live
we
the
love,
king.
we love kings. We love kings. Roland puts in, Pablo, in addition of everything that Gregg has mentioned, there are strategic tax opportunities and benefits that being a landlord has provided. So, thank you for those contributions. And we also have some good questions flowing in to ask you, Gregg, which I want to get into. We're coming up on that half an hour mark. I know that we're also going to give a status of JWB operations. We're going to give a rent collection number status, and we're going to give a leasing status update as well. So for those of you that can stick along with us, thank you. And we're going to get into that. For those of you who can, who only have a half an hour, we know that this is Tuesday. This is going live right now in our Facebook group that you can join by going to jwbfacebookgroup.com. And that is where we have over 1,500 investors that hang out with us on a daily basis. Gregg goes live in there in the mornings, and he does a real estate walk and talk. It's where our community lives in between our shows. But also, if you just want that presentation, go to jwbshow.com to understand the basics of rental income property investing and JWB's philosophy for doing it. Or like I did last week, if you want to ask the JWB team exactly how to fit this into your portfolio in the way that it is right now, go to chatwithjwb.com and pick out a time that's best. So I'm gonna sprinkle in some questions real quick, Gregg. Maria from California asks, and I lost it here, but what parts of Jacksonville are the best parts to invest in?
Yeah, absolutely. So when you're thinking about making an investment in rental properties, you want to focus on overall a market that has low prices and high rent. So the first thing is look at all the markets out there, see which ones have lower prices than the median home sales price in the nation, and also see the ones that have the higher gross rents than the nation. Jacksonville happens to be one of those neighborhoods. Or one of those areas. So then the next question is, once you know that Jacksonville is an area that you're interested in, what neighborhoods? And guess what? You follow the same exact methodology, right? You want to find the neighborhoods that have low prices and that also have high rents, high rentership, that are surrounded by jobs and are in neighborhoods that you're going to find really quality management. I only say that because sometimes you'll find some neighborhoods that have low prices and high rents, but they are not in neighborhoods that you're going to find quality management because they're too rough and there's too much maintenance and vacancy costs. So that's a little bit of the theory behind it. There's 4 neighborhoods that we have invested in since 2006. And then we put all of our clients in all of Jacksonville. And Jacksonville is huge. It's actually the largest city in the country by land mass. And there's only 4 neighborhoods that we just basically dominate. One of them is the west side of Jacksonville. One is the north side of Jacksonville. One is called South Side, and one's called Arlington. If you'd like more specifics, again, ask you to reach out to my team. What we do is when you get on a phone call with us, we actually bring up a map of our footprint in Jacksonville. And you're able to see, and I think we did this on the show not too long ago as well. We kind of showed all of the pinpoints of all the properties that we sold to clients that we currently manage. Right? There's 3,500 homes that we manage in Jacksonville, and you just see these like cutouts of basically JWB activity on the landscape of the overall Jacksonville market. But yeah, that's where we funnel all of our activities. It's because there's prices that are lower than the median home sales price in Jacksonville. So median home sales price, let's see if you're paying attention, Pablo. Median home sales price in Jacksonville as of June.
Oh man, it's like 250 something.
Yeah, man, 255, close enough, right?
Yeah.
So
Maryland
home prices are between 160 and 200,000 for a typical JWB property, lower than the median home sales price. And then you're going to want to find high rents. It's a little bit harder to find neighborhood specific as far as rent rates, but you got to have some local experience there. And that's where you find great rental neighborhoods, a high portion of renters surrounded by jobs and really high rent rates. And you'll find it in those 4 neighborhoods.
And I just put in the chat. So if you saw my face doing weird contortions while Gregg was speaking, it's because I was looking for that video. I just put it in the chat. We did an episode about 3 weeks ago that is the best neighborhoods to invest in Jax that he was just referring to. So that's a live link. You can click in there. And Maria, I suggest that you check that out. Nuria is also asking a similar question, right? Within Jacksonville, can you give pros and cons of each area? Outlook, such as Arlington, West Side, South Side, Paxton, North Side. maybe we can dig into that. So there, I mean, you'll be able to go into there and see the whole outlook, but can you give pros and cons to Arlington, West Side, South Side, Paxton, and North Side?
So those neighborhoods are chosen because they are all extremely similar, right? Out of all of Jacksonville, we chose these 4 neighborhoods. And why do we do that? It's because they're the same neighborhoods, right? If I was to bring you here on site, which we do, we bring our clients, we fly our clients in for campus tours, except during COVID time, of course. It's one of our joys. And what clients tell us when they come on site, and we cover the cost for them, by the way. So that's a beautiful thing for you to be able to come and meet our team and see all the properties and whatnot. And one thing we hear is, as we're driving from the West Side or from Arlington or South Side, people say, wow, what neighborhood am I in again? This looks very similar to this last neighborhood. And this neighborhood looks exactly like this neighborhood, because we'll have maybe 3 or 5 clients that are on the tour with us at that time. And so there's not a whole lot of differences between those neighborhoods, because that's how it's designed. It's the same thing over and over and over again. They're all below middle income neighborhoods. That's where you want to be investing, because that's the cash flow sweet spot right there. A lot of times I'll get asked the question, and they're all job creators. Some of the job creators are different between the different neighborhoods, but they're significant job creators, right? It might be the Port, which serves the North Side and it serves Arlington, right? It might be NAS Jax, which serves the West Side, right? It might be the South Side, which downtown serves the South Side jobs up there in St. Nicholas, right? So the job creators might be different, but it's the same thing over and over again. A lot of times people ask questions, should I invest in one of your neighborhoods because I should expect higher appreciation rates? And my answer is no. I come to you guys with data-driven decisions, right? And I don't have any data to support that the West Side is going to appreciate more than the South Side or Arlington or the North Side where we invest. At the same time, I'm coming from a long-term buy and hold outlook. Those are the type of investors we want to attract. You want to be holding on to this property for the long haul, at a minimum 5 years, but what we recommend is a 10 to 20-year hold or longer. And over a full market cycle, you're going to see that you're going to find that home price appreciation tends to repeat itself over a full market cycle. Goes up about 4%, 4.5%. And so I don't have any data to know what this is going to be in 10 or 20 years and why one area would be different than another. It's just buy-in for the cash flows, buy-in for the passive income, buy-in for the team managing it, and then hold on for a long time, and then expect roughly 4.5% appreciation is really our mentality.
I love it, man. Every time that you give a tidbit that I would think that doesn't really serve you to give, I admire you for it, Greg. But that's what we're here to do, right? Like, we're just here to be transparent, and it doesn't have to be these neighborhoods. It's not that they appreciate more, but there is a thought, there is a strategy behind all of this. The more I peek into the JWB universe, the more I see how extremely well thought out everything is, and I think it's awesome, man. Do you want to, speaking of thought out, right? Like, we're going through COVID, kind of a second wave. Can you give us an update on operations and how you're moving forward with that?
Yeah, this has been something we've been talking about often, and a lot of you have been asking questions and having concerns, as we all are concerned about how to operate in a time like this, right? So what we did early on, once COVID broke, is we made the decision to go remote. It was, I don't know, end of March we made that decision, I would imagine. And that was a quick transition for us, but it was really smooth and seamless. It was a really cool moment to be able to do it. Our team was fantastic, overcame some minor challenges, but from an IT perspective, from a systems perspective, we were built for it. We started making decisions to invest in systems many, many years ago, and some major, major investments over the last couple of years. A big investment into Salesforce, which we've spent tons of money on over the last 2 years. Big improvements on our self-guided showings software, and then adding that onto the back of Salesforce. We did all these things really over the last 2 years. That self-guided showings upgrade was done in Q4 of last year, right? And then clearly we had no idea what was coming down the pike, but how amazing has it been for our clients, for our team to be able to have, I was pulling the numbers in June. We had over 1,900 showings for homes for rent in June, which is an insane number, right? We have 12 people when fully staffed on our leasing team. right? Imagine if we had to go and show 1,200 homes, even in a non-COVID time, right? You couldn't do that, right? And now, especially for social distancing. So we've made a lot of those improvements, and the transition to going remote was about as best as we could have hoped. May 18th, we made the call to ease our way back into coming into the office. And we did a group A and a group B thing where half the team was on group A and would come in for the group A week, and then half the team was on group B and would come in the following week for group B. And we did that all the way up until last week. There have been rising cases in Florida, as many of you have heard. And for us, we wanted to make sure this was an opportunity to do right by our team. And so we made the call proactively to go ahead and go fully remote again. We feel blessed that we can do this and see no dip in performance as we've been able to show in the past. So it's not that hard of a decision as far as being able to perform for clients, but it is a hard decision because we love being in the office. And, it's hard to enjoy the culture as much as we normally do when we're remote. We've had no positive COVID tests on the team, which I should also share. So very, very thankful, very blessed for the health and safety of our team. But now we're remote again. And we just shared with the team that this is going to be an ongoing discussion. My business partners and I spend every Wednesday together out of the office. We talk through the entire business. I tell you, we spend at least an hour or two every single Wednesday talking about topics like this, talking related to COVID. So we'll keep you updated. But as of right now, JWB is fully remote again. And, for the foreseeable future, that's where we're at.
Sounds good. I want to touch on what you just said right now, right? Like you spend every Wednesday out of the office. And to me, that's something that I always harp on, right? So anybody that's new here, I was just kind of hired to help tell the story of JWB, right? I'm an outside contractor. So I've been learning about this business for the last 6 months as we go through this process. And my first interaction was the Tuesday morning meeting where the entire staff shows up, and I've never been to a 1 hour full staff meeting where everybody is so engaged, and I knew immediately that there was something special there. But as we peel the onion, like one of the things that I find remarkable is this idea that the 4 partners that run the business, that are the heads of decision making, are completely unreachable every single Wednesday because you spent the whole day together planning and foreseeing issues like this, which is no surprise to me why you had already led the charge in the technological the digital adaptation of all these processes that allow you to work remote and allow you to continue all these critical processes such as leasing, which I actually rent collection, I think we probably want to talk about next, right?
Yeah. I mean, and that Wednesday meeting is something that we started many, many years ago. It actually used to be in our office, which is kind of funny because we would go into a meeting room and, it's my business partners and myself, and we're 4 of the most stubborn guys. We care tremendously, and we've known each other for decades now. We've been working together for decades, and, some of us have been best friends since high school, right? Like, so there are going to be fireworks from time to time. So we used to have it in the office, and we didn't realize like the effect. We yell back and forth. We talk through issues. We laugh, we joke, we build our relationship. We continue to reinforce it, but we yell. We used to have it right in a room right behind here, actually. And we realized we needed to get out of the office when we would have new teammates. Cause at that point we had maybe, 50 or 60 people. And some of them didn't know us and didn't know how we were acting. They're like, oh no, the owners of the company are yelling and screaming at each other. What does that mean? And, they just don't have the context of it. So that meeting is a real big source of our success. It is. We invest that time every single Wednesday. And then, from that meeting, we have an incredible leadership, and we make sure that the message makes sense by all parties, that we're putting people first in our decisions. And our leadership team is fantastic, and they're the real winners when it comes to some of the numbers I'm going to share with you here. So let's talk about rent collection. A lot of folks have been concerned about collecting rent during COVID time. Again, if we set the perspective early on, Pablo and I got on the show, and I said I'd never been through something like this before. I can't come up here and tell you that I know exactly how this is going to work out. I would expect a short-term, temporary loss of rental income, but I thought that it would be a lot more consistent than other asset classes. And I was right about half of that. It was a lot more consistent than other asset classes. The part I was wrong about is we really haven't seen a dip in rental income. So a normal month for JWB comes in at 98.5% of rent collected. And I'm looking at the numbers here. April and May and June were all between 97.5% and 98%. In a time when you cannot evict from not receiving rental income from residents. So an incredible accomplishment by our team. Sure, it helps. The systems are there and all that good stuff, but the people that we have care tremendously. And the relationships that we've built with our residents are showing through in this time. So we're very happy, very thankful. And it should mean a lot of confidence coming to our investors, which it has, that your rental income continues to come in, your consistency is still there. That's the reason why you came to this asset class. It's not what you're getting in the stock market, and you're still getting it even in the time of this pandemic.
Yeah. Again, no surprise to anybody that's been following along with the show. We report these numbers all the time. At first I think it was eye-opening. At this point, I'm like, all right, buddy, you're doing great. Super. Good for you.
What happens if we show up at like 96% one month? We're gonna be like, oh no.
I don't know what'll happen. So I just want to say Maria Makas, who I think it's Makkas. So I'm assuming it's a Greek last name. She says, next time I'm in town, I would like to come by the office. The Greek is probably the most stubborn and the loudest.
I'll give you that, Maria.
Alex Safakis, right? So let's move into leasing, Greg. What does leasing look like? You referenced that there was 1,900 showings and a record month, right? But maybe just put a button on that one.
Yeah, everything in this business model starts with renting homes and collecting rent. If we are great at collecting rent and renting homes, clients can be happy. Right? If we're not great at collecting rent and renting homes, clients are not going to be happy. We could have some concerns. The consistency wouldn't be there. All of that goes down the pike. So it's a huge focus for us always. Our leasing team is putting up some numbers that we've never seen before. So to put it in perspective, last year in 2019, we rented 995 houses, which was a world record for JWB. We'd never rented that many homes. This year, we're on pace to rent 1,300. Wow. Even during COVID time, we have rented the most homes in a single month that we ever have. June for us is not typically a month that is the highest number of move-ins for that month. But in June, we moved in 113 new residents into homes, the most in any month ever in JWB's history. And again, seasonality does come into play a little bit on renting of homes, typically around your tax return time. So your, February, April, May time, absent of COVID, those are the times when you typically see the highest numbers of homes rented and moved in. So to have it happen in June is huge, and to have it happen during COVID is incredible. So as of right now, we manage over 3,500 homes. I checked the numbers 2 days ago. We only have 55 available homes, and the average days on market for those homes is just 25 days. That's over 98% occupancy. So our leasing team's never been in a better spot, and I'm so thankful for their efforts. And it's really serving our clients well. At the end of the day, we look at it we said this early on, that this was a moment for us to show our clients that we're reliable even when the rest of the world isn't. And we feel really good about being that source of consistency for everybody.
Outstanding. All right. So that kind of wraps up the whole update that we're doing. So we're going to do a couple more questions here. So Lee Bishop, who always has awesome questions, and he had asked this early on, but I let you go through your thing. He says, I love the way JWB can control the market price for their new houses and ensure increase in value to current investments. My question is, how closely does JWB watch to make sure that the comparable numbers stay consistent in each neighborhood?
It's a great question. So what Lee's talking about is the fact that although Jacksonville is huge, and JWB, you may think we're big, you may think we're small, it depends, it's all relative, right? We sell about 450 to maybe 500 homes a year when you think about all the different sales that we have. So in an area like Jacksonville is 3/4 the size of the state of Rhode Island, right? 450 or 500 sales across 3/4 the size of the state of Rhode Island is not a lot. But just like the earlier question about neighborhoods, we do the same thing over and over again, and we just dominate certain neighborhoods. So that helps clients because we don't have question marks about what the value of the home is, right? We don't have questions about what's the home going to appraise for a sales price to make sure your financing goes through. We don't have questions about what your home is going to rent for. So to answer Lee's question, how much do we pay attention to this? It is all day, every day. And it's because if we did look on that map, and Pablo, thanks for bringing up that previous video where we showed that map. That would be great for everybody to go and take a look at. You're going to see that in the same neighborhood, like a property, like maybe Pablo, maybe you're going to buy a property. I would imagine a property that you're going to purchase at some point is going to be surrounded by 25 or 30 homes within a half mile that we have built or we have renovated and we have currently rented and we sold and we know what they're selling for. So it creates this great level of stability for you. It removes any customer service issues for us because, when you go to other turnkey companies, many times they're spread out even in different markets across the country, or even in a certain market, they're spread out everywhere. They're trying to find a deal anywhere because they're searching for inventory. Well, what happens then is when you go to get a loan to buy it, sometimes that's in a neighborhood where there's not other sales that are happening. And that appraiser might have a really difficult job understanding what the value is. That appraisal might come in low. And so other turnkey companies have a difficult decision to make. Many times they make you buy the property for more than market value or some other way. But at the end of the day, it's a bad situation for you because it creates this stressful event. JWB, we don't have to worry about houses not appraising, right? Now, appraisals aren't a perfect science, but well over 90% of appraisals come in at market value or above market value for JWB, whereas other turnkey providers don't have that luxury. So for us, our clients are always able to purchase their homes at market value. The houses will appraise. Even if there is an issue where we had an issue on an appraisal, we're going to talk through that with you. We're going to make sure that you're able to buy that asset at the appraised value. And a lot of that is due to the fact that we do the same thing over and over again in the same neighborhoods. That's why we do it.
Sounds good. I'm going to qualify something real quick. So right now, as tends to happen, we get a barrage of questions like late in the show, which is why on Thursdays we have the Not Your Average Investor all Q&A edition, right? So I'm gonna try to hammer through a lot of these questions right now that are being asked. If we don't get to your question, I'm going to ask it on Thursday. So if you want to join us again on Thursday, if you can't make it Thursday, let us know, right? I can have the team reach out and answer your question individually, right? But I'm going to try to rapid fire through this right now. Ready?
One more thing, other resource for everybody. If you'll join the group, we do a replay of this call every Tuesday night at 9 p.m. in a watch party. You got to be in the group to do it, but I'm there. I'm answering questions. There's a lot of follow-up questions that we didn't get to in the show. And so you can go right there. I'll be there to answer any questions you didn't have. And, it's a nice little fun watch party where we all get to joke and laugh a little bit too. So you can go to jwbfacebookgroup.com and apply to get in the group. And then we'll see you there.
Cool. Yeah. Great call. So, all right. So let's do this. Marilyn Cotterman asks, since interest rates have dropped, how long does someone have to wait to refinance? Is there a period of time you have to wait before refinancing?
It's a great question. A lot of times, you may run into things called title seasoning. Pablo, you love title seasoning, don't you?
It sounds delicious.
Makes the title just taste so good, right? When you put a little seasoning on it, right?
Yeah, it's like a Memphis dry rub title seasoning.
Title seasoning. Sorry, guys. This is kind of how we are. Title seasoning refers to how long the previous owner has owned that property. And certain lenders out there have title seasoning rules, which is what Marilyn's asking about. How long does she have to own it if she owns that property before the lender will allow her to refinance her loan out? Some title seasoning requirements are 6 months, some are a year, 2 years. So I would encourage you to find a lender that doesn't have any title seasoning. For any of our JWB current clients, in our approved network of lenders, you're not going to find any title seasoning requirements. So Marilyn, I know you're a private lender with us. And so for any refinancing, we'd be happy to introduce you to our private lender network, and you're not going to find any title seasoning requirements there.
Excellent. So if we're talking about lenders, I'm gonna sprinkle in different rates of questions here. Okay. No, sorry. I'm just going to keep going here. Roldan Crepo, has JWB changed their tenant eligibility criteria since COVID-19? This as a result of the high unemployment rates?
It's It's a great question. Have we changed our tenant screening criteria? The answer is no. I've gotten this question a few times over the last couple of shows, and it kind of struck me as odd in the beginning because we think one of the reasons why we're able to have 97.5, 98% of rent collection is because of our tenant screening criteria. It's a lot harder to rent from JWB than it is in the normal marketplace to rent a home, and we want it to be that way. We think that's the best way to serve you long term to make sure we can continue to collect rent. So this is not a time where you're going to see us change our requirements to make it easier. If anything, we're going to continue to push the boundaries to make sure we get more qualified residents to fill your homes.
That's right. And, this is where as a marketer, I'm always impressed with the scope of your marketing machine, right? Like you guys, instead of relying on Zillow, instead of relying on all these like arbitration sites or, signposts to fill your houses, like I've seen behind the curtain of your like SEO, known universe, all these different like high level marketing concepts that you use to, you don't apply it for rental income property investors. You apply it for renters, right? So you have this like amazing queue of people that are lined up to take your homes.
I pulled the numbers here. I'm going to make sure I get it right. We had 5,702 new leads to rent our homes just in the month of June from all of our marketing channels. It was the most we've ever had. And that's not repeat people coming back. We're the biggest single family property management company in Jacksonville. So people see our ads, they come back. It's not even counting those people who came back. It's a beast. And we have to do this type of volume to get tenants that are going to sign 2 and 3 year leases for you. We're going for a very small segment of the population here. And we do that because it's going to benefit you long term.
Yeah. And for the record, I short circuited earlier because I'm trying to keep track of the Q&A plus the chat, right? Like it would really help me if you put the questions that you want answered in the actual Q&A box, right? So either way, not complaining, just making excuses for myself.
Beautifully, bro. You let's give Pablo some love. Tell him how good he's doing, man. He makes it look seamless, but that is really, really difficult. And then I throw some questions at him once in a while just to see if he's paying attention. And you're like 97% accurate on those too, man. My brain would be fried, man. You do a good job, buddy.
It is all iteration, man. It's practice. We've been doing this a long time. So that being said, these lender questions that I was looking for before, thank you, gentlemen that have done this, right? John Moran asks, does your lender lend based on property income? I'm an investor and do not have W-2 earning.
It's a great question. So what John, I believe it was John who asked the question, right?
It was John Moran.
Okay. So what John's asking about is getting away from what we would call conventional lending, conventional financing. Conventional financing is backed by Fannie and Freddie. That's where you get your best interest rates. When I'm saying you can get interest rates in the 4%, that's what I'm speaking of. They're going to qualify you on you as the borrower, very, very small percentage on the property. But it's basically lending to you. What John's talking about is going outside of those to non-conventional lending. And so we do have some non-conventional lending. Typically, your non-recourse lenders are going to be an option. Typically that's for retirement account as well. But I wouldn't completely shut the door on buying properties with non-conventional financing outside of your retirement accounts. We do have some programs within our lenders that allow people to buy properties. For example, if you have over 10 finance loans on your credit, we can make sure that you get a loan. Well, I shouldn't say we make sure you get a loan. We do have a program. You have to qualify as any other loan. I sound a little bit like a car dealer right there. You get a loan, no income. That's not how it is, right? Anyways, we do have a program with some of our lenders that can work for you. Specifically, if you don't have W-2 income, that's a challenge. I would still reach out to my team, set up a time to chat. There may be some potential there, but it's much less likely. It would probably be a non-recourse loan, or you're getting closer to like hard money or that type of a loan, which typically hard money doesn't work typically for rental property investing. But if the funding is the big challenge for you, we find that the funding is the easiest obstacle to overcome, either now or in the near future. So I would highly encourage you to chat with my team. We can give you a bunch of ideas, even if you haven't even if you're not able to get a loan right now. you're probably not too far away.
Okay, perfect. Vinay is asking in the chat, how do we tap into this program? I think you answered that, right? That's go to chatwithjwb.com and you take it from there, Vinay. And we'd love to talk to you. So Jen Adamson, by the way, it was two Johns that asked a very similar question. So that was John Evans and John Moran that were kind of asking those same questions. Gentlemen, I hope that answers your question. If not, follow up, right? Because I'm kind of lumping it in there together. Jen Adamson, welcome, Jen. Good to have you here. Asks, what if you're in that 2% of landlords that aren't getting the rent collected? How do you handle the non-payers right now?
I feel for you, Jen. It's a tough spot right now. We talk glowingly about the big percent there of rent collection, but there's 2% that aren't receiving rent. And unfortunately right now, there's not a whole lot of consequences to a resident not paying rent for the here and now. The foreclosure and eviction moratorium has been extended through August 1st. That's been extended a number of times now. We don't know if that's going to be extended or not, but it hurts as an owner. So what do we do to avoid that? Well, we're in constant communication with our residents first and foremost. I mean, a lot of the reason why residents are paying right now is because we help break down the fact that just because there's no consequence, you can't get evicted for not paying rent right now, that doesn't mean this is a time to not pay rent, because it doesn't mean the rent is forgiven. The rent is due, and it's going to be a large amount that's due when, foreclosures and evictions can happen in a short period of time. So it comes down to that relationship, working with that resident. There are other things that we can do. We work with other charities around that might be able to supplement. We have some great relationships there. I would encourage you to look into those, who might be able to supplement your resident with maybe a one-time gift to help them pay the rent. But you're going to start to see a lot of things really fall into place when the eviction and foreclosure moratorium is up. And, there's different schools of thought on that, but it certainly will help rental property investors once we at least can operate as a normal property management company and evict people who are not paying rent, even though that doesn't mean we're going to do it every time. We're going to still work with compassion with our residents. It's important to do that first and foremost, because occupancy at this time is much better than not treating people the right way, and it's much better than the turnover cost that may be avoided if you can work out a solution and get paid over time.
Great. And Maria Makis is actually asking, do you do management for properties not bought through JWB? The answer is yes. JWB has a property management company. Is that also chatwithjwb.com, Greg?
Yeah, absolutely. You can go right there, and it'll be the same team members that you'll be working with, whether you're interested in buying a turnkey rental property with us or whether you'd like us just to manage a property that you already own. Chatwithjwb.com is your source there. Okay,
great. And we are at the hour limit that we have here. We still have 3 questions. Marilyn, Vinay, Bill, Rebecca just put one in there. I encourage you to come to the watch party tonight or join us on Thursday. If you can't do that, you can reach out to us in the Facebook group or shoot us an email. We'll get your question answered, or go to chatwithjwb.com, right? Happy to answer questions there. Again, chatwithjwb.com is where you can set up an appointment at your leisure to ask any question that you want and have a personal answer. If you just want to spend 45 minutes learning about rental income properties, go to jwbwebclass.com. Thursdays, we have this same thing, but it's all Q&A. It's just me and Greg here talking. And normally we have interviews, right? Next week, we have Keith Weinhold from Get Rich Education Podcast, who's a good friend of Greg's that's going to be joining us on the show at this time. So if you want to meet Keith, you've been listening to the podcast for a while, you want to ask him a question, Keith has a really interesting perspective on the landscape of rental income property investing, because he's been educating people for so long, bringing people onto the show for so long. So if you want a truly unbiased opinion on really the landscape of all of it, I think that's going to be a really, really great show for everybody. But apart from that, I just want to thank everybody for joining us. Super well-attended call. We had like 60 people on for a while. We appreciate you taking a Tuesday to spend some time with us. And I'm going to pop it up to Greg to finish us off here.
Great show as always. So much fun to be here with you guys. I can tell that the Jacksonville market updates are really important. So this is something that we're going to be doing for our turnkey clients once every 2 quarters. So this is something that we'll bring to you guys at least once every 2 quarters. Or like always, you guys let us know what you'd like Pablo and I cater our shows to you guys. We want it to be fun, engaging, and enjoyable. So appreciate all of you for being here. And hopefully I'll see you guys in the watch party tonight at 9 p.m. Just find us in the Facebook group. Thanks, everybody.
Adios.